How are you doing today?
Dave, doing well. How are you?
Good. I want to start by saying this was unintended, but I appreciate the tropical theme here. You've got your tropical shirt on, and I have surfers on my shirt, so totally unplanned. But I like the fact that it's Friday and it's a little more casual.
Absolutely. It's actually sunny here in Portland, Oregon, so I had to take advantage.
Wow, that's kind of a rarity for you guys, right?
It is a little bit more
Awesome.
than I would like. Yeah.
Well, today we want to spend some time and talk about kind of the current market conditions as it relates to the real estate market, housing inventory, interest rates, and how all those things are kind of interrelated.
Yeah, and I think the biggest elephant in the room, Dave, is that a couple years ago there was a big discussion and lots of media coverage around a pending housing crash. Now, what is your impression of how that's worked out over the last 2 years?
Well, I think if you look at all the data from all the different companies that measure home prices and home price appreciation, you'll see that across the board that historically, up until the most recent quarter, home prices have actually increased consistently. Probably not at the same pace as we've seen historically, but they've still increased. And I think the forecast for those same companies for the balance of this year are the same. And I think a lot of that has to do with the shortage of inventory we're seeing in the housing market right now.
So, one of the things that we talked about before this show is that there are some basic economic factors in play right now that are having an impact on the marketplace that is different than kind of a 30,000 foot view might say, oh, we had home prices go up, they must go down. But we have some different market forces in play today than basically in most other times in our history in the business. And can you go into that a little bit?
Yeah, so I guess I'm thinking back, way back to my economics class or one of them in college. And the most basic principle of economics is what? Supply and demand, right? And so right now, we're probably seeing a little pressure on both sides because the demand has been a little bit less just because of elevated interest rates. Although a lot of people will say, oh my gosh, interest rates are so high. Well, for those of us that have been around for a while, seeing rates in the low to mid sevens really isn't high, but again, relatively speaking, to what we saw a few years ago in the mid twos to mid 3% range, yes, they're over double. So I understand that side of it. And then the other component is inventory. And I think those are really related because what you typically find is that people that are in a house at a 3.5% interest rate are less willing to sell their house and move up to the house they really want because of the higher interest rate. And they're like, I don't want to get rid of my low 3.5% interest rate, so I'm not going to sell. And so that's putting pressure on the inventory because now there's fewer homes for other buyers that don't own a home today or want to move up to that home to not purchase because there's just not many homes available on the market.
So, kind of the projected impact or likelihood of a housing correction was mitigated actually by the very thing that has kind of put a damper on housing affordability, and that's the interest rates, because so many people got into the opportunity of having a lower interest rate, like you said, that, effectively rates more than doubled for some folks. And you could upsize a house and pay a lot more, or downsize and actually maybe still pay more than what you're paying for your existing house, kind of locking in the inventory. We've got some charts and graphs to help explain what's going on there with supply. But you're bringing up a great point about market forces dictate real estate values.
Yeah, absolutely. Well, and definitely want to, get a little more, I guess, a little more technical, but also to support that with some graphs, because sometimes it's easier for me to kind of see what's going on visually versus just hearing it. But, I heard something on listening to the news yesterday around, well, there's, one person says there's going to be a housing crash. And again, it depends on what channel you watch to see, which side of the news you hear. But the reality is that if the rates do come down, again, back to the basic supply and demand, you would expect that demand for housing would go up because that affordability is better now, right? And that goes for both sides. So that could also mean that inventory levels will rise because now those people that are locked into their 3.5% rate on their home now are saying, oh, geez, now I can tiptoe back in the market again because that 3.5% rate isn't as important to me now because I know I can get into a new home or the home I really want at a little more affordable rate than where they are today.
You bring up a great point, and the other thing about a housing correction means sellers are kind of unwinding their real estate positions in a little bit of a need basis. And right now, something we didn't actually get a chart on is that we're dealing with record amounts of equity in a home. And therefore, these people that have homes that are willing to sell if rates come down a little bit, it's on an opportunity basis, not on a need basis. And so it's a want, not a need, meaning they're not going to flood the real estate market with homes for sale at a discount. These are homes for sale so they can go get the next one, but other people are going to be in the mix to both buy their house and get the next one that they're after also. So this is going to be an interesting time as we come out of this.
So that's another really good point, Eric, and one that I really wasn't planning on talking about. But you brought up the point about historically high equity positions for homeowners nationwide, which is absolutely true. The unfortunate side is, as we hit the end of 2023, we also saw the highest increase in consumer debt, especially credit card. We hit $3 trillion in consumer credit card debt in the fourth quarter of 2023, which is insane. And what that's done for us as a lender is that we've seen more and more people now that have wanted to get either a home equity loan, a second, or do a cash out refinance to pay down those credit card debts that are in the 20% range, even though it means taking a little bit higher interest rate than what they have right now. It still makes financial sense from a payment perspective. But that is what we're seeing now too, is that because there's been that huge increase in consumer debt, we've seen more and more people looking at their blended rate, so all of their debt combined and what that blended interest rate is, and actually taking advantage of refinancing just to lower their overall debt service on a monthly basis.
Absolutely. So the sit and hold strategy of holding on to the property, realizing that you have a historically amazing interest rate that you're maybe willing to give up so that you can cash flow better and manage your personal balance sheet and your personal income and expenses a little bit better. Yeah, we have had legitimate inflation in the country. I think everyone's trying to figure out what's going on with inflation and recession and rates up and rates maybe down and all this. But we have had everyone that goes to the grocery store, fills their tank with gas, or goes to a restaurant, sees and feels what it means to have inflation and pressure, therefore, on paychecks.
Yeah, absolutely. Well, let's look at current market if we can, Eric, and let's look at the active listings that we're seeing in the market today nationwide.
I just shared the screen. Can you see that, Dave?
I sure can.
Okay, so this is the housing inventory active listing count in the United States. So as you can see, and we know being in this housing industry for some time, that actually if you go back to this 2016 through 2020 timeframe, home inventory you could see was on a down slide. And if you had more data off to the left here, you would see that we're actually lower in inventory than we have been historically for this amount of population. So coming into the COVID effect, right around here, you can see this little gray line being a recession. We had already fairly low inventory, and then it really hit a historical low mark in terms of inventory as many homes were traded, but not a lot of homes were in active inventory status because there was so much activity. We have less activity today, but we also still have less inventory. So it's not like there's an oversupply of homes for sale and they're just sitting for people waiting to have a better deal of a house for sale down the road. And so we're coming into this environment where there may be a lower interest rate picture 6-12 months from now at a really, really low rate of inventory.
And I think typically you got to factor in some seasonality in this too, right? Because typically as we hit the spring and summer months, that's typically when the real estate activity picks up a little bit. Kids are getting out of school. Families want to get settled into the new home before the kids start school in the fall and things like that. So,
absolutely, and we should note that this is from the Federal Reserve St. Louis data. That they supply data to the government. They supply data to the consumer public. This is available for free. People can look it up on, if you just type into Google Fred and St. Louis, you will come up with the opportunity to look for data out there.
And you can chart yourself to death on this one because
You sure can.
there's a lot of information available and it's a great resource for sure.
So
Well,
the
so
next
how
one,
does
oh,
this?
go ahead.
Oh, I'm
Go ahead.
sorry. I just wanted to see. Well, good transition. So I just wanted to see kind of how that related to the median sales prices, like we had spoke to earlier, across the country.
Yeah, so we have to remember first off, what's the definition of median? Median is not average. So median is the, if you had 15 different homes for sale here and they all sold, then it would be the eighth home as far as what the value would be, and that would describe what the median is. So half of the homes are above this in value, and half of the homes are below this in value that have sold. So if you have more lower priced homes selling, each home could be worth more than it was a year ago, but it could bring down the median, just like it could bring down an average, but it could bring down the median. And then if fewer expensive homes sold, which is kind of a reality we're seeing right now, expensive homes were more affordable with lower interest rates. There's been a pullback on that a little bit, so probably a little less expensive homes sold in most markets, meaning that that can cause the median to go down as well. But that does not mean a single house went down in value. That means that in the homes that have sold, this is what is reflected in the value as a median.
So that's the difference between home prices declining and the median home price declining.
Right. So
Got it.
your pool of homes is not consistent in terms of which ranges of homes and how many are sold over time, but the median is simply just tracked over time, which can be a fair representative, but it's not when the market shifts down or up, it's not an immediate indicator of what's happening to an individual house.
And I think in most typical markets too, we see that higher priced inventory takes a little bit longer to sell. You see more days on the market than you do with lower priced homes. And again, because you've got probably a smaller population that can qualify and afford the really higher priced homes. And so that's reflected in this as well.
Absolutely. So you can see we did have a spike. This is the COVID, boom years, but we haven't come off of that much. And if you can see this consistent line here, we're kind of trending right back to where that's going to kind of catch the escalator again and keep going forward. So this idea that there'd be this real fast drop off of median home values is mitigated by the last screen we saw, and that is that there is a historical low still of homes for sale.
Gotcha. So how does this relate, Eric, to if we looked at, because we saw, rent prices, during COVID, I think went up quite a bit, but how does this relate to, renting versus mortgage payments?
That is an excellent transition. So this is from the Mortgage Bankers Association, and again, MBA. So if you typed in Mortgage Bankers Association in Google, you will find that they have the weekly charts, and you can go look at some historical weekly charts. And this right here, this orange line would be the one probably to pay attention to. This is a sector of the homes versus rents, but this is all of the applications that are tracked here in the Mortgage Bankers Association's data pool that relate to if someone was applying for a home loan and got a home loan, what is the new home loan in relation to what they had with rent right before they obviously transitioned to buying. So right here, this 1.5 number would indicate that let's just make it really round numbers. If a new housing payment obligation was 1,500, and that would mean that their previous housing obligation was 1,000, right? So it's 1.5 times more to buy a home right now relative to the rent that people were paying. Now, that doesn't mean it's the same square footage or amenities or anything like that. It just means that what they were paying compared to what they're applying for and receiving.
Got it. But I guess this is another point that the one thing you can control is what your mortgage payment is, right? But you can't control the rent. So, and I think we'd get down to, so if you look at the dip in that chart there on the orange line, that was at the lowest point of the interest rates. And so if, everything comes to fruition as kind of everybody's predicting it will towards the end of this year into next year, that 1.5% or 1.5 times should get lower as interest rates come down. However, there's no indication or guarantee that rents will go down, and so you should see that gap get a little bit closer.
That is a perfect segue to yet another Mortgage Bankers Association chart that we screen captured just to make it not with web pages behind the scenes. And this, let's take this piece right here with a grain of salt. This is a projected drop in interest rates. Now, whether it happens, now, which would be kind of now right here, it didn't happen yet. Whether it happens out here. So whether this drop that's anticipated happens here, 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 it is anticipated that we will see a fall off in the federal funds rate, and we will see a corresponding drop in what happens with mortgage financing rates. Historically, you can see that they trend fairly close together, and this is not in relation to each other. This is in relation over time for each category, but they stay pretty tight as a group as time passes. So while this is a blip with a much higher interest rate compared to where things were with housing, you're going to see that likely come back down, and you're going to see these other trends. So these Zillow rent, CPI rent, forecasted principal and interest is this green one, asking rents, equivalent rent. So what you're going to see is over time, they're kind of still constrained and held together, little blips in time, like a seismic shift, like what the quick interest rate increases did. You will see a better relationship to each other right here between the different categories. We saw this blip because of the interest rates, and interest rate increases don't immediately impact rent payments, right? Rent contracts and that sort of thing. But over time, these are going to trend more closely together as they have in the past, meaning that you're going to have housing become more affordable against rents. And to your point, with housing, you don't lock in every cost about housing, taxes, insurance, these, maintenance, but you do get the opportunity on a fixed rate product to lock in a housing payment and to start having amortization work to your benefit. Whereas with rent, 5 and 10 years from now, you don't get that benefit.
Right. And I think the big question right now is, well, when are rates going to go down? Because, last year we heard the Fed was going to reduce rates 6 times during 2024. We haven't seen that yet. And obviously the biggest drivers are inflation getting under control, employment, and then obviously we have an election coming up in fall of this year. So I think all of those 3 things will have an impact on when rates come down. And I think if either one of us could predict when that would happen, we actually would be on a tropical island right now instead of doing this video. So nobody knows when that's going to happen, but predictions all are saying towards the end of this year or beginning of next.
Absolutely. So while picking a specific date is difficult for a transition in the marketplace, the forces here are indicating that at some point there will be a transition in the marketplace again.
Awesome. Well, good information, and yeah, I appreciate you sharing, especially on the graphs, because just that visual is really helpful again.
Absolutely. Good stuff, Dave. Thank you.
All right. See you next time, Eric.
You too.